Good afternoon, everyone. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Welcome to this week's Mortgage Minute, coming to you from Palm Springs and the greater Coachella Valley area. Weather-wise, it's kind of back to normal seasonal weather, warm but not hot, very comfortable. This is the kind of weather that brings people here to the valley every spring season, so we're enjoying that after that pretty much the whole month of March heat dome that really was throughout all of Southern California. It's been a really exciting week. In particular, Artemis 2 launched, as you may know. I happened to catch that online and saw the launch. Very exciting. Kind of interesting. It's been over 50 years since we've sent anybody over to the moon neighborhood. I can remember way back when I was 11 years old, our family sitting in the living room watching the moon landing. So very exciting that we're heading back to that area. I understand this is going to be the longest moon flight on record, given the amount of distance they're going to be covering. In fact, including they're going to be on the backside of the moon. So yeah, really, really exciting stuff. I understand China is looking to put a astronaut, one of theirs, on the moon by 2030. I have a feeling we're going to be focusing on beating them to that. And getting somebody on the moon before 2030. So we'll see if that plays out. Again, very exciting stuff. I'm glad to see it. I think that's the kind of thing that can bring us all together and root for something bigger than ourselves. So also, of course, the big sports news this weekend is the Final Four. Very interesting how it's played out. I don't know if any of you saw that UConn-Duke game. Wow, amazing game. Duke had that game, and I was shocked to see UConn hit that three-pointer just about at the buzzer. That surprised a lot of folks, and I'm sure most brackets were broken already, but that kind of destroyed them even more. I had Duke in the Final Four, so of course that didn't happen. And of course, baseball's in full swing. My Angels actually started off pretty hot. First couple of games, they won. Our star player Trout seems to be getting back to his old ways. At least he started off that way. He's sort of settling down into some more, I guess I'd call normal numbers. But overall, pretty promising that he seems to be back to his healthy self. So we'll see how that plays out. Although I think Dodgers are the ones to beat on paper. I don't know how they could be beat. I mean, they clearly have the best team in baseball. Of course, they paid for it, which of course is controversial in the baseball world, and we'll see how all that plays out in terms of if there'll be any changes. So let's look at what's going on in the mortgage market and the bond market. First, we're going to pull up our rate grid. It's not terrible news. Yes, rates are up from a month ago, but they're still, pretty decent. Conforming conventional loans were a little over 6%. There was some concern here earlier in the week, the headlines that rates could be heading to 7%, but they seem to be settling down. The 10-year bond yield has settled down. We'll touch on that in a minute. But you can see there, I mean, these rates that you can see on our rate grid, we've been at these levels before. So a little bit odd that there's all this hand-wringing about rates have gotten terribly high again. They really haven't. And, of course, FHA, VA is still in the mid-5s, mid to a little bit upper 5s. But overall, these are still very good rates. And I'm going to comment on that a little bit later as well when we get into our Q&A discussion segment with Jeff. But again, particularly look at those buy downs at the top. Despite the run up in rates that we've had, I mean, you could still do a 3-2-1 or a 2-1 and get a start rate in the 3s, low 3s or low 4s. I mean, that should get folks' attention in terms of those who want to buy a home, but they're concerned about affordability. Again, we can help you with that and show you how you can end up with a very comfortable payment, even at these interest rate levels. So let's look at the bond market, the 10-year bond chart that we always like to provide you every week. This is a chart showing the bond yields since last Friday. And of course, Jeff is circling right there. That's the Wednesday, Jeff Harrison dip that he likes to point out. And yes, we did see that. It's up a little bit today, but it started off higher by a good amount early today, but now it's settling back down, as you can see, 431. About a week and a half ago, the 10-year bond yield was starting to get close to 450. So we have seen some improvement. What we want to see here is that 431 get down into, it'd be great if we can get back down under 420 or 410. And again, we were at that level not that long ago, very early March, late February. So this chart shows you the right kind of trend with that little blip today, but overall, I think we're heading into the right direction. It seems like things are settling down a little bit. Of course, from our current administration, there's continued suggestion that we're nearing the end of the Iran war situation. Hopefully that will be true, because if it turns out that is true, that should bring oil prices down pretty quickly. And if that happens, we should be able to see the bond yields drop pretty quickly as well in response to that. Because again, high oil prices are considered very inflationary, which is why we've seen the bond yields go up and therefore mortgage rates. So what particularly is going on in the markets in terms of data? Well, let me go over a few things. It's not a particularly heavy week in terms of economic data points. Primarily, it's about home prices and job numbers. And the first thing that came out earlier this week is the Case-Shiller index. That index, well, there's actually a variety of different versions of the index, but the one that tends to hit the media is the Case-Shiller 20-city home price index. And the media like to point out the fact that it did show home price appreciation as more or less stalled. It's certainly moderated. It's plateaued. The index for January showed a 1.18% increase in median home price from a year earlier. And those who want to point out the negativity of that, in terms of financial writers, point out that when you account for the current inflation rate, this suggests that homes are now really for the first time are exhibiting a decrease in net value, after inflation value. Yes, that's true. I would not get too excited about that. I certainly wouldn't want to suggest to anyone that this is a precursor to maybe an extended period of home prices falling. I do not think you should think that. I think this is actually an opportunity that home prices have moderated. And again, we'll get more into that when we do our Q&A discussion period or segment of the program. The other thing that came out this week in terms of job numbers is JOLTS, the Job Opening Labor Turnover Index or report. The number came out at 6.9 million in February. Again, 6.9 million job openings. Previous to that, there was 7.2 million. Now, a drop in this number is considered to be an indication of a softening labor market. And potentially, if it stays well under 7 million and maybe even gets further below 7 million, that's a sign of a recessionary environment. I'm not sure I would jump to that conclusion quite yet. And of course, part of that reason is some of the other job numbers. ADP, for example, came out this week. And again, that's not my favorite report. ADP, of course, as you know, is a payroll processing company. They issue this report every month in terms of job openings. And they did report 62,000 private sector jobs were created in March. And that was a big increase from a 39,000 private sector job forecast. So you look at that and you say, okay, well, we've got private job formation much stronger than forecast, then how can we suggest that the labor market is softening, as would be suggested by the JOLTS report? So this is a good example of some contradictory economic data points that can make it a little bit more confusing to sort out which direction we're headed. I did see the initial claims for unemployment benefits came out today. I didn't put it on the chart. And it actually came out lower by 10,000 for what was forecast. It was 202,000 new claims for unemployment benefits versus 212,000 forecast. Again, if less people are filing for unemployment, that would suggest maybe the labor market is not softening all that much. So again, another confusing data point. The rest of the week is tomorrow. That's the U.S. employment report, which is going to, of course, include the number of total jobs created. And again, for that report, which does include government jobs, not just private sector, 59,000 is forecast, which is similar to the ADP report we got yesterday. And the forecast for unemployment rate is for it to stay at 4.4 million. 4.4%. And again, if that proves to be true, you would have to then call into question is the JOLTS report really that accurate in terms of predicting a softening labor market if the unemployment rate stays stable? And if we're seeing an increase in new jobs, then that would tell me that maybe the labor market is in pretty good shape despite, again, the media headlines. So there you have it. That's the kind of data that's been released this week that's affecting what's going on in the bond market as well as the stock market. Of course, for mortgage purposes, we want to focus on the bond market. All right, with that, we're going to go ahead and go into my next subject. It's somewhat of a product spotlight, but in fact, what I wanted to cover, we recently had a question from one of our viewers, and this has to do with getting a reverse mortgage. And there's the question: can I get a reverse mortgage if I have bad credit? That's a very good question, and I think you're going to be pleasantly surprised at the information I'm going to give you to answer that question. So, of course, I'll start with basically, yes, it is possible you may be eligible to get a reverse mortgage even if you have bad credit. Now, what that means, one of the things about a reverse mortgage, and here I'm going to be talking about the core reverse mortgage product that is originated in this country. It's called a HECM. That's an acronym for Home Equity Conversion Mortgage. It's an FHA loan product. And one of the interesting things about the HECM loan product is there is no minimum credit score required. Now, FHA loans, in terms of traditional forward mortgage FHA loans, there is a minimum credit score requirement of 500. Now, many lenders don't originate FHA loans at that level, but some do. And the cutoff point there is 500 to 580 on a forward mortgage FHA. You have to put 10% down rather than the normal 3.5% down. You have to be 580 or higher to be able to go 3.5% down. But on a reverse mortgage, which is, again, also an FHA product, there is no minimum credit score required. It's not 580, it's not 500, it's not 620. There is no minimum credit score. The reason is that in terms of evaluating a reverse mortgage borrower, credit history over the past 2 years carries more weight than your credit score. So that's really the focus. When you're going through a reverse mortgage application process, you are going to be subjected to financial assessment, but that's entirely different than documenting your income and making sure that you're meeting a particular debt ratio, because, again, you're not required to make monthly payments on a reverse mortgage. So that kind of takes away the whole concept of meeting a debt ratio, since you're not making a monthly payment that would be measured by that debt ratio. So as a consequence, you're not approved or evaluated financially with that approach at all. So what is it about credit history that could, make or break your ability to get a reverse mortgage? Well, let me give you some examples. Your credit history would be considered satisfactory if you do not have the following. On revolving payments, if you've had revolving payments made that are more than 90 days after the due date, that would be a problem. Or if you have 3 or more payments on a credit card that are made more than 60 days after the due date, that would be a problem. And when we say 3 or more payments, we're talking about in the last 12 months, and as well as the more than 90 days. So those would be situations where you would have some trouble in getting approved if you demonstrated those kind of late payment histories on a credit card. On housing payments, let's say you have an existing mortgage that you might be wanting to pay off with your reverse mortgage. You do not want to demonstrate or show that you've had more than 2 30-day lates on your mortgage. Again, after in the past 12 months. And then with installment loans, you are allowed to have a couple of lates, but not more than 2 30-day lates on installment loans in the past 24 months. So if you're within those parameters, not more than 90 days on a credit card for 1 payment, not more than 60 days late for 3 payments, not more than 2 mortgage lates, and not more than 2 installment loan payment lates within the last 24 months, then you should be okay in still being able to get that reverse mortgage. And again, we're not going to look at your credit score. The lender does not look at that, so you don't need to worry about what your score is. Now, there's a whole nother section of derogatory credit that could be a factor Let me show you a few now. These include judgments, collections, charge-offs, delinquent federal or tax or non-tax debt, and delinquent FHA mortgages. Now, these get handled a little bit different way. If you have an outstanding judgment, you're going to have to demonstrate that you either have a payment plan set up with a judgment creditor, or you could be required to pay off the judgment with part of the proceeds from your reverse mortgage. Collection accounts, typically with a collection account, you may or may not have to pay that off with your proceeds from your loan, but you would at a minimum have to explain the circumstances to explain how that collection account came to be. Now, charge-offs, generally speaking, you're not going to have to pay those off because, after all, they've been charged off by the creditor. They're no longer actively collecting on the debt. That's why they've reported it as a charged-off debt. Now, again, you may have to explain what transpired to create that situation, but in most cases, you're not going to be required to pay off a charged-off account. Now, if you have delinquent federal debt, tax debt, or non-tax debt, you're either going to have to demonstrate that you've set up a payment plan. Like, for example, in tax debt, the most common we see is folks are delinquent. Maybe they haven't been able to make their most recent tax year income tax due payment. And so what folks will often do is they'll set up an IRS installment plan to pay that debt. If you can show evidence that you've set that up, that can be acceptable, and you would not be required to pay off that delinquent or past due IRS income tax liability. And that would be true too if you have some sort of delinquent federal debt that's not tax related. Same thing. You would have to probably at a minimum explain why it happened and then show proof that you have an installment plan set up. Otherwise, you may have to be required to pay that off with your loan proceeds. And certainly if you have a delinquent FHA mortgage, again, because the HECM, the core reverse mortgage product, is an FHA product, if you have an existing FHA loan that's delinquent, you're going to have to bring that current before you can close that HECM reverse mortgage. So keep that in mind. And then the last thing I want to cover, because this is always on someone's mind if they are in a situation where they feel like they've got credit that's too poor to get a HECM reverse mortgage, is bankruptcies. Now, in bankruptcies, when you're talking about a forward mortgage, Fannie Mae, Freddie Mac, FHA, VA, yeah, you've got waiting periods where there has to be a certain amount of time that's expired or transpired from when your bankruptcy was discharged until when you're available to submit an application for a mortgage. Fannie Mae, Freddie Mac conforming loans, that's 4 years. Now, FHA, it can be 2 years. So what's interesting about the HECM reverse mortgage is they're a little bit more lenient. As you can see there, if you have a Chapter 7 BK bankruptcy and you want to get a reverse mortgage on a home that you currently own, we just have to establish that you've had at least 1 year since the discharge. So it's not 2 years, it's not 4 years, only 1 year. So you could have had a Chapter 7 bankruptcy that was discharged January of 25, and you would be eligible to get a HECM reverse mortgage. Now, if you're going to use a reverse mortgage for a purchase transaction, then the waiting period is extended. If you've had a previous Chapter 7 bankruptcy, you've got to wait 2 years since the discharge before you can use a reverse mortgage for the purchase of a home. So I wanted to share this information with you. So if you are in a situation where you're a senior homeowner, you've had some trouble getting mortgage financing, maybe you're trying to get an equity loan, or maybe you're trying to refinance your mortgage, and you're running into issues because of some of these derogatory credit situations that may be seen in your credit history, a reverse mortgage is going to be a little bit more, I'll call it, kind to you in terms of being able to still get the financing despite these kind of derogatory credit events. So hopefully that'll give you some hope that all is not lost. If you're in this situation, you've had some financial difficulties. Of course, that's part of the reason a lot of homeowners end up getting a reverse mortgage, is because they're running into financial difficulty. They need access to cash. And of course, then they have to figure out how to do that. If they own a home, they've got a lot of equity, or their home's free and clear. Well, keep in mind now that despite these derogatory credit items, if you have experienced some of these kinds of situations may not preclude you from getting that reverse mortgage. If you have any concerns about that, you're not sure, give me a call. I'd be happy to go over your situation specifically. We can get your credit report pulled and give you a better idea if you're going to be in a good position to get that reverse mortgage or not. And of course, if it's a, or not, then we can help you to determine what you need to do strategically to get your credit situation cleaned up to the point where you can apply for the HECM reverse mortgage and be able to get the access to the cash you need. So I hope that's helpful. And again, it's a little bit of a product spotlight regarding reverse mortgages and your credit history. All is not lost. In a lot of cases, we can help the homeowners even when they face some of these credit challenges. So again, don't hesitate to call me, and we'll be happy to go over your specific situation and see if we can help. So with that, I'm going to have Jeff come back in because we're going to do a little bit of discussion about what's going on in the mortgage markets right now. Hey, Jeff.
Hi. Hey, Art. Hey, before we get started, I just wanted to say to those people who are following us on streaming, we've got a nice group of people, but there's been some issues at LinkedIn. Apparently, there's a little bit of an outage or something going on at LinkedIn. We're having trouble streaming there, so I apologize, but you can still cover us on Facebook and also on YouTube. So hopefully you've made the transition over there, but Art, this is good news. This is good news. It you don't have to have perfect credit to get a reverse mortgage. That's very good news.
Well, it is, and one of the things about senior homeowners, and we do see evidence of this from time to time. It's a little concerning. I mean, there's some senior homeowners out there who've experienced a reduction in income for various reasons. Maybe they retired or they ended up having a job loss or got cut back on their job and so forth. And some of these folks are, having some challenges just financially. And so often a reverse mortgage is looked at as a last resort option. And even then, some folks maybe talk themselves out of even trying because they feel like, or they've kind of self-determined that, oh, my credit's not good enough. And I want to make sure I can, knock down that perception and get people to realize, even if you're not in the best shape financially, the reverse mortgage could still be a very good option if you're a senior homeowner that otherwise meets the eligibility requirements. And so, yeah, give us a call and I'd be happy to go over that and make sure we can determine for sure if that's going to be a good option for them. So.
Yeah, I think some of the preconceived ideas of like I have to have 20% down and I have to have this level of credit and those type of things. Yeah. We have a lot of, I remember a show you've done in the past where it said 71% of seniors that are being interviewed said they were concerned about running out of money before they ran out of days on this planet. And that's a concern. And this is, as you say, maybe think of it first, not last, and be part of your kind of your retirement program. Yes.
Yes, exactly. And again, I think we'll talk about that here shortly. So,
all right, here we go. All right, so this is a fun part. We call it the AAA moment. Ask Art anything. So these are some questions that have come in, Art. Let's just. I have a good job and finances are solid. Should I wait before buying a home to see if rates improve or prices come down? And this came from somebody who was concerned about the whole Iran thing and oil prices up, all that kind of stuff. So I think this is a good question.
Yeah, I think it is. And of course, in responding to that, folks, if you watch this program on a regular basis, you're going to feel like, oh, I'm just repeating myself. But I think this underlying is a very good question, particularly in the current environment, because what's going on here with this current environment, I think it's causing a little bit of paralysis in the markets, in particular in the real estate market. So I want to kind of confront that head on and try to explain to people why I think that's maybe not the best approach. The first thing I would say is ignore the headlines, ignore groupthink, ignore the madness of crowds. I can't stress that enough. Try not to get, drawn down into this malaise of things are really, uncertain and unstable. And, it's just not the time to do anything. We need to stop and pause and just not take any action, even if we're desperate to own a home, for example. So that's the first thing I would say. It's just, you got to ignore the headlines. Don't fall into groupthink or the madness of crowds, because I've always been a believer that whatever the crowd's doing, look the other direction and see if you can find an opportunity that this crowd over here is not paying attention to, or because of the headlines have convinced themselves there's no hope. So I can't stress that enough. Now, the idea of home prices coming down. Yes, I just mentioned the Case-Shiller Index. It came out pretty The media basically suggesting it's a weak number. And then, of course, net of inflation, it's a negative number. Home prices have fallen slightly. I would suggest to folks, if you're in this situation, you don't want to fall into that trap of believing maybe even though the January Case-Shiller number did come in pretty weak, that's an indication of a trend. I would strongly urge, don't start thinking that. And one way you can do that, Google a historical chart of U.S. residential median home prices. And so I did that. And it's very interesting when you look at it. Now, most of the charts you can find are going to run from about 1965 to now. And when you look at it, the trend of the chart is pretty consistent slope upwards from the lower left to the right, 1965 to now. There's very few dips actually in those median prices over that 60-year period. There was a slight dip between 1968 and 1970, another slight dip from 1979 to 82, another slight dip from 1989 to 1992, and of course the one that is still fresh on everybody's mind, even the younger folks who maybe weren't really around, or they were youngsters like toddlers, whatever, but they heard from their parents, the period from 2007 to 2011, the Great Recession, when in that entire 60-year period, that in that particular period was when we've seen the biggest drop in home prices over that entire period. And again, you have to consider what was the economic circumstances at the time. That was a unique set of circumstances. The mortgage industry had gone a direction that really got away from itself in terms of due diligence and making sure people really had the ability to pay on their mortgages. Way too many people were given mortgages they should have never gotten because they really didn't have the ability to pay them. And that all had to do with a lot of things, and what I don't want to get into, but a lot of initiatives from Fannie Mae and Freddie Mac to improve home ownership. Our federal administration at the time promoting home ownership, but it was at the expense of making sure people can make the payments. And so I would argue that one big dip was a unique event that I don't think is going to repeat itself anytime soon, in large part because a lot of the rules changed. So that's one thing I would point out is if you look at that chart, you should not get yourself into thinking you're going to see a big drop in home prices anytime soon. So you've got to accept things where they're at and then try to figure out strategically how can you then approach your goal given these circumstances. Same thing with rates. I pulled up a historical chart of rates, residential mortgage rates in the U.S. And again, very interesting. Here's one little tidbit a lot of folks may not realize. From 1972 to 2002, mortgage rates were in a range of 16.5 to 6.5. My point there is for that 30-year period from 1972 to 2002, mortgage rates during that entire 30 years were at levels higher than we are now. And yet currently, in part because of how the media portrays things, folks are in this emotional state of they're just distraught about how high mortgage rates are. Well, guess what, folks? Historically, it's just not true. Mortgage rates historically, even right now today with the run-up we've had the last month or so, are still historically affordable when you look at the history of interest rates. From 2003 to 2021, rates were in a range of 5.9 to 3%. So for those who are thinking we want to see rates come down, well, of course, we always want to see rates come down, but we still have too many folks that are hoping, wishing of getting back to the 2s and 3s. It's not going to happen. That was an artificial circumstance, once in a 100-year pandemic that the entire economy was shut down. The federal government stepped in, pumped money into the money supply to help prop up the economy. That drove rates to zero. It was a temporary artificial event. It's not going to be repeated in our lifetimes. Even the younger folks watching in your lifetimes, very likely. So stop waiting for that because it's just not going to happen. So that would be another point that I want to make onto interest rates. Therefore, waiting for lower prices, Waiting for lower interest rates, I just think, is a fool's game. Back to the headlines. More than 50%, we talked about this last week, more than 50% of listings nationwide are over 60 days on the market. I would argue even here in our local market, that's becoming the case. And most of Southern California, that's becoming the case. I saw a headline just this morning, brutal spring housing market. That was the headline because the housing market this spring is not showing to be as robust as normal, in part because of all the anxiety about international events, and rates have gone up and oil prices are gone up and the Iran war and so forth. Mortgage applications nosedive. That was a headline this week as well. And then finally, if you look at closing price to list price, now in most markets, including ours here, it's between 3 to 4%, meaning homes are selling at about 3 to 4% below their list price. So when you look at all that, I look at opportunity. Everybody has gotten into this groupthink. Things are awful. It's going to be a brutal spring. Oh my gosh, why would you buy a home now? We need to wait for rates to drop, for prices to drop, which isn't going to happen. Sellers are struggling with their homes on the market for 60 days. They're not getting offers. If you're a prospective buyer, I'm like, this is great. I need to get with an agent. I need to get with somebody who can help me with the financing. I know a guy. And talk to us. Let us help you take these conditions and take advantage of them. You can make an offer on a home. Don't be bashful. Ask for a concession of 5% of the list price. You say, well, wait a minute. That's a lot. Well, if homes are selling at 3 to 4% below list, you're in that range, a little above it. But consider what would you do with that? Well, a 3-2-1 buy down. That's going to cost about 4.5 points, 4.5%. And you might say, well, okay, but gosh, trying to get a seller to agree to give me 4.5% of their list price, so I can use it to buy down my rate. That's a tall order. Well, first of all, it's not really 4.5% of the list price if you're making a down payment. For example, $600,000 home, and let's say you're going to put 20% down. Well, if you want a 3-2-1 buy down, it's going to cost 4.5% of your loan amount, which is $480. Well, what is that 4.5% of $480 as to the list price, the seller's asking price? Well, then it drops down. It's not 4.5% of the list price. It's about 3.6% of the list price. Well, voila, you're now within that 3 to 4% range that the data shows homes are now selling at under list price. So if you realize that subtle point, it's not so unreasonable to ask for that kind of seller concession. And then that way you're able to get a loan package where you're not going to pay 6 1/8% for the first 30 years. You're going to pay 3 1/8 for a year, 4 1/8 for a year, 5 1/8 for a year. That payment savings gives you the window to then refinance later when rates will eventually come down. They're not going to go to 2 or 3, but certainly they might get down to 5.5 or 5 or 4.5. You've got that 3-year window. You've taken advantage of the current environment where you're able to get concessions because of all the reasons we just described. And then you've got that 3-year window to refinance into a lower note rate. In the meantime, you're enjoying much lower payments, and you can own that home much more comfortably than if you just went with market rate and asked for no concessions. So in my mind, that would be my advice to somebody in this particular situation.
Sounds like a solid yes.
Yeah.
Yeah.
Again, do it the opposite of what everybody else is doing. You have less competition. As a prospective buyer, you have less competition right now. And you should take that, embrace it, and use it to your advantage, and prepare to be strategic. And you'd be shocked at what you can accomplish in this environment. And again, because the reason you can be that successful with this kind of strategy is because most of the rest of the people you're competing with are simply not thinking this way. They're thinking, oh my gosh, bad news, things are terrible, I've got to wait. Well, it usually doesn't pay to wait.
Yeah. And the other thing that just popped in my head as you were describing this situation, I'm thinking, if I were a realtor and my client has a home that I've been trying to sell and it's been on the market for, 45, 60, 90 days, and somebody comes up with an offer like you've described, I'm probably going to do my best to get them to accept it, because it's like, hey, we haven't had a whole lot of people coming through the door. Maybe we got to take this. I don't know. Maybe is that naive to think that?
No, not at all. In fact, frankly, a good, experienced professional realtor would not think that. He or she would have a serious discussion with their seller about the current market environment. If you've got a listing and you've had it on the market now for over 60 days and you haven't adjusted your price and you haven't gotten any offers, the market is screaming at that seller that you're not priced right.
Yeah.
Now, you can either say, well, the market doesn't know what they're talking about. I know my home better than everybody else. Well, you can sit there and flounder. But the risk of that is you become a stale listing. And eventually, all the other agents out there showing buyers homes are going to like dismiss this one like, yeah, that seller is not reasonable. They're not realistic. That's a dead listing. Let's move on. You can't let yourself fall into that situation. So a good listing agent, when they're having a seller where the market is signaling to them that their price is out of whack with what the market is dictating, they have to have a heart-to-heart talk with that seller and make them realize, look, the market's telling us we're priced too high. We've got an offer here. Yeah, they're asking for some concession, but again, the data over here shows if we do eventually sell your home, we're probably going to end up 3 to 4% below your asking price anyway. So let's embrace this offer. Yeah, we'll try to tweak it a little bit and try to save a few bucks, but take it and work with it and work with the buyer side and negotiate a good, outcome, and a bit of a compromise between what you thought your house was worth and what this buyer and what the market, and more importantly, is telling you. Your price is too high. You need to adjust it. Why not, in doing that adjustment, do it in such a way you're giving some dollars to that buyer to address their biggest concern, which is affordability and rates, and give them an opportunity to get that rate down, get the payment down, so everybody's happy.
Before we go to this next question, I just want to ask one more prying question is, well, if there's more of, I'll call it negotiating room for the seller to buy a home, why wouldn't I just take that up front as cash, just reduce the price? Isn't that a much more beneficial way to go, Art?
It's less beneficial.
Oh.
If you just want the concession to come off the price, a lower price. And again, that's in the resale markets, that's by far still the most typical way to try to get concessions. Just ask for a lower price, offer below list, or if it's your listing, lower your list price to attract more interest. I've said before, I'll say it again. That is probably, if you're the buyer and if you're financing your purchase, that is the least effective way to achieve more affordability in your monthly payment. And the reason is very simple. Yeah, if you offer a price below list, yes, that means depending on your down payment percentage, your loan amount's going to be a little bit less as well, right? Well, what folks forget is each $1,000 borrowed is only worth about $6 a month in payment. So if you're looking at a listing of 600, I'll use that again. That's a median price out here in our valley, and you want to offer 580. That's 20,000. Oh, well, I'm sure that's going to help my payment a great deal, even with my 20% down, right? Not really. $20,000 lower loan amount, which actually, if you're putting 80, if you're putting 20% down, 80% loan, your actual reduction in loan amount isn't the full 20. It's about 80% of that. So, but still, we'll use 20 as a round number. A $20,000 lower loan amount at $6 a month is $120. Okay, that's worth something, right? But if you took that same $20,000 and you did a temporary buy down, whether it's a 2-1 or 3-2-1, that first year, that monthly payment isn't going to be $120 lower. It's going to probably be $600 lower.
Oh.
So you're getting the same concession amount, 20 grand, but instead of taking it off the price, you're going to pay full list. you get the 20,000 in cash, then you apply that toward your loan to buy down your rate, either permanently or temporarily. And in a lot of cases, there'll be money left over that we can also apply to some of your closing costs. So when it comes to getting a concession from the seller, as a buyer who needs to get a loan to buy, you are always, 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 I would argue, my opinion, going to be better off get that concession as a credit from the seller. Don't take it off the price. And let me show you how much more effective that's going to be to give you more comfortable payments in the future.
Well, if you're on the fence now after that explanation, you probably should just tear down the gate, because the obvious answer is you need to act now and take advantage of the conditions, because they really are ripe for buyers. Let's go to the next question, Art. The next question is coming up. It says, I'm tired of paying rent and getting no financial gains. What choice do I have as a single person?
Okay. Well, a couple of things. First of all, I will say, because I want to make sure I'm giving a balanced view of this, because I don't want to beat up on renters per se. Yeah, I understand tired of paying rent, no financial gains. We talked before, the Federal Reserve every 3 years studies this issue about wealth creation, and they've shown time and time and again that if you're a renter, your wealth creation opportunity is probably over lifetime $10,000. If you're a homeowner, it's close to $400,000. It's 40 times, right? So you go, okay, well, what can I do? I want some financial gain, but I'm a renter. Well, again, there's those who argue you can continue to be a renter and achieve similar financial gains to home ownership, but you've got to reallocate your household funds, your budget, and get more of those funds kind of pushed toward financial investments, stock market, et cetera. And, there's some news stories coming out lately. The Gen Z folks are starting to do that more. So I want it to be understood that is an option. I think it's very viable. It's possible. However, most renters, and the data shows this every 3 years, most renters don't do that. So what does that really mean? Well, you've got to reallocate your household budget. You've got to understand that you've got to get away from certain things that you really may cherish. That fancy car, you got to get away from high car payments. The average car payment in this country now is $800 a month. 20% of car payments in this country are now $1,000 a month or more. The average new car price now over $51,000. You're going to have trouble as a renter, and you want financial gains, if you're having too much of your funds going toward fancy wheels. Now, look, I'm a car guy. I love cars. I'm a racing fanatic. If I had my choice, I'd have a Ferrari and a Maserati and a Beamer, all in my garage, all that. I mean, trust me, I understand. But I also understand that that's not going to get me where I want to go from financial wealth, stability, and so forth. So you've got to find a balance there. So I would argue you got to get rid of that $1,000 a month car payment and get a $350, $400 a month car payment if you have to get a car payment. So many folks who are renters and they want financial gains and they're frustrated, they'll say, well, I'm bogged down because I got to save 20%. I got to save up that 20% down payment. No. Stop doing that. It may sound strange. I tell people all the time, don't be trying to save up 20% down for a home purchase. Don't do that. If you're going to save up some money for down payment, keep it to 3 to 5%, because in most cases, that's all you're going to need. So instead, to the extent you were saving up so much money for 20% down, instead take those dollars, divert them to what's the other thing? You've got to attack the credit card debt. Credit card debt is a complete obstacle to building wealth, financial gain. You will never get wealthy borrowing money at 25%, particularly when you're borrowing money that you didn't really have to start with when you wanted to do whatever fun thing you wanted to do, whether it's just a fancy dinner out, going on no expense spared, vacation, whatever it might be. So you've really got to attack debt. That's really one of my big points here with this question is you're better off attacking debt than trying to save up 20% down payment. Save up a much lower amount for down payment and take all your dollars and apply it toward reduction of debt, because that's much more of an obstacle getting you qualified to buy a home than how much your down payment is. In part for what we pointed out earlier about, each $1,000 is only $6 a month. So that isn't as effective putting more down to help you qualify. Removing debt is. And so really, so then even if you do all this, then Jeff, what will end up happening is we'll still have some people say, well, look, okay, I did all this, or I'm doing all this, but I'm still single. And I still feel like getting into a home is just not achievable, right? Because it's just me. Mm-hmm. Maybe I don't make enough money by myself to achieve the home ownership goal and the wealth creation that I want to achieve. So then you say to yourself, well, what else can I do? Well, as we talked about recently, this is where consider buying with a trusted friend. A lot of us, when we were young, I told the story when I first got out of high school, me and two of my high school buddies, we immediately moved out, rented a home from my girlfriend's father, and we split the rent. And we did that for a few years. Well, why not do that, but not by renting, but buying a home? So if you do all these other things financially in terms of reallocation of your household budget to eliminate debt, save up a little money for down payment. It doesn't have to be a lot. And then if by yourself you don't have the income to get what you want, buy a home with a trusted friend, or maybe family member, siblings, maybe a couple of brothers or a brother sister. If they're with it close in age, a year or two apart, like my siblings are, and you're young and you want to buy a home and your sibling wants to buy a home, consider doing it together. And again, this is your springboard. It's your first home. You can share it together, and then you'll have a strategy over time to maybe then move out of that, each go your separate way, keep that as a rental property that you can co-own, or maybe you sell it, you split the proceeds, and then again, you each go your separate way. But the point is, it gets you into the game much earlier than being buried with all this debt, trying to save up for a 20% down payment. You're not going to get there in most cases, or at least not till you're 40, where we see a lot of most first-time home buyers now are 40. There are ways to avoid that if you pursue some of these strategies.
I love that. Well, it's like getting in the game now when you're 25, 26, even if it's co-buying, and you now are 14 years ahead of what is now the average age of a first-time home buyer. You're well on your way. And I'm just curious if you mentioned like a brother and sister, use an example, and let's say they buy a home, I don't know, let's say it's modest, it's $425,000 here in the Coachella Valley. In 4 or 5 years, what kind of average appreciation could they see that either A, they refinance it and split that money and go their separate ways and keep it as a rental property, or sell it? What kind of gain could they anticipate?
Well, consider this way. The average appreciation rate for a residential home, and this is used in a lot of mortgage disclosures, for example, with a reverse mortgage. And I think it's a pretty solid number in terms of what's a reasonable rate of appreciation that folks, I think, can expect. And I think is supported if you, again, Google a chart of home prices historically over the last 60, 70 years, a 4% appreciation rate. So if let's say you buy a home for 400 or 500,000, and let's say it's 500. Well, a 4% appreciation rate, what is that? Well, that's $20,000 a year. Actually, it's a little more than that as you go into each year because it's compounded off the increase off the first year, right? So, over 4 or 5 years, right, at a minimum, you could see that $500,000 home may be worth $580 or $600. Well, there you go. And again, wow, once you get to a point where you don't want to live with your trusted friend anymore, or you don't want to live with your sister or brother anymore, you want to go your separate ways, then you got options. You can keep that home, rent it out, and you co-own a rental property, and then maybe from there you may end up acquiring others. Or you could sell it, split the proceeds, and then you've got more down payment money. So then at that point, maybe in your life, you're financially able to go on and buy another home by yourself without a trusted friend or relative. But the point is, it gives you that foundation to then in the relatively near future be able to springboard that initial foundation into something much more, rather than just continuing to wait and trying to save up that 20%. Next thing you know, you're 40 years old, you're more than halfway through your life, and you've built no wealth creation at all.
Yeah, I think that's just solid advice, Art. Thank you. This next question, this is the last one. It says, I have owned my home free and clear for a while now. I'm 60 years old. It's just me and my wife, no children. How does a reverse mortgage fit into a retirement plan?
Well, I think the key part of this question is the last part of it, fitting into a retirement plan. Again, what we see too often is too many senior homeowners don't think of a reverse mortgage as part of a retirement plan. They think of it as a last resort. And
Mm.
again, there's still too many homeowners who still have way too many wrong notions about what a reverse mortgage is and how it works. And, I don't own my home anymore. The bank does, all that kind of stuff. So when you layer that into the fact that people aren't thinking of the reverse mortgage as a strategic financial tool, that's why too often we see folks come to us for a reverse mortgage when it's like they're in almost a state of desperation. It's a last
Mm.
resort option. I need this to pretty much save myself financially. So that's the first thing, is I try to encourage people not to think that way. The other thing to keep in mind, in this particular question, it said, well, I'm 60 years old. Well, if you're 60, it is true that you're not going to be eligible for the core reverse mortgage product in this country, the HECM reverse mortgage, because the minimum age is 62. But part of what I would tell this particular person who asked the question, if you're 60, you still have options. With the lender we use, there are multiple reverse mortgage options if you're 55 or older. So you don't have to wait till 62. So that would be something I would want to emphasize, is that even if you're only 60, but you're feeling like it may be something you might be interested in, we can give you some options, even though you're not 62 and can't get a HECM. And then the other thing is, again, don't use it as a last resort. We talked about the John Wooden quote here recently. When that opportunity presents itself, it's too late to prepare. And again, that's what we see too often. A senior homeowner hasn't prepared, haven't thought of the reverse mortgage as a financial tool, and then they have an opportunity that presents itself, or a challenge that presents itself, and they're not prepared for it.
Mm.
Sudden health issues, job loss. The home is desperately in need of repairs and things are starting to break, and they don't have the financial wherewithal to address those. So then they're scrambling to find options. So that's an important point to make, is don't think of the reverse mortgage as your last resort. Use it strategically. Because one of the things that folks don't realize, if you're free and clear, maybe you do have a job and your income's okay, you're pretty comfortable, you got a little bit of money in the bank, you feel like, well, I don't need one. I don't need to use up my equity and getting cash that I don't maybe need right now. Well, maybe true, but the reverse mortgage is a financial tool that you should still consider getting earlier, not later. And even if you don't need the cash right away, realize there's a way to get it set up so you have access to the cash when an opportunity or challenge presents itself later. And then you don't have to scramble to try to get this in place. You can get it in much earlier when you don't have that critical need or opportunity. And so when you get the loan, you don't draw much out of it at all. But then what you do is you set up a line of credit.
Mm-hmm.
That line of credit sits there, and if it's not being used, it's got a zero balance. Two benefits to that. One is you're not incurring any interest costs because you haven't drawn against the line of credit yet. And number two, the line of credit, the credit limit, it grows over time.
Mm.
The zero balance portion, and let's say it's a total zero balance line of credit for, let's say it's $100,000 and you have no balance. Well, each year that line of credit limit's going to go up. 100,000, 104,000, 110,000. So over time, that rainy day fund that's sitting there, not costing you any interest because you haven't drawn on it, is growing. So that even better prepares you for, again, that unforeseen challenge or opportunity later, because you've already got that financial tool, that loan in place, and then you just draw the money when you need it. And the last point I would make on that is for those who, in this situation, I'm 60, no kids, I'm living comfortably, and maybe I've got a pretty sizable, retirement account or IRA, whatever, investment account, and I'm drawing money on it every month to supplement my household, monthly budget. A reverse mortgage is a great tool for what we call sequence of return risk. For those who feel like they're in well position. They don't need a reverse mortgage because that's a last resort kind of option. No, use it now, get it in place, have that line of credit set up. You're not drawing on it. But what if we have a 20% correction in the stock market and you've been drawing, $5,000 a month out of your financial account to live on? You don't want to keep drawing that $5,000 a month at a time that your portfolio has dropped by 20%. You stop those withdrawals, and then you're pulling against your reverse mortgage line of credit to supplement that income. And then once the stock market corrects itself, then you can switch back to drawing out of your financial investments and stop drawing on your reverse mortgage line of credit. So those are the kind of strategic, flexibility and options that a reverse mortgage can provide you, even in a period and in a time period where you don't think you need it. And so I try to stress that enough as much as I can, because I think most senior homeowners just don't think of it that way, and they really need to.
Well, you make such a great point there of when you take action and you're not prepared, it's a problem. It's almost like, God forbid, we have a hurricane. We have a earthquake here in the valley, and we sustain damage, and we don't have water. Now is not the time to thinking, well, I think I'll fill up some buckets of water for drinking. It's too late. You have to have that stuff prepared. And I really like that last example you're talking about, because I'm thinking, oh, you're right. If I don't have to use it, it's still growing because of that 4% appreciation you were talking about. On average, it could be higher, it could be lower, but historically about 4%. So it's growing even if I don't touch it. I love that idea, Art.
Well, exactly right. And it's a real good option to getting a traditional HELOC, because one thing that's happened in the HELOC world in the mortgage business, if you want to get a traditional HELOC, either as a first mortgage, or maybe you have a small mortgage and you're going to get that as a second mortgage behind your first, there's a fair amount of homeowners out there. They want to get the HELOC as a rainy day fund. They don't really need the money right away. Well, lenders have gotten wise to that. So if somebody comes to me and they want a traditional $100,000 HELOC and they don't really have a need for the money, but they tell me, I just want to get it and put it in place so I can access it later. Okay, fine, we can do that. However, most lenders now won't let you just get it and let it sit unused. They'll force you to draw at least $50,000 or 3/4 of the credit limit at closing. Wow. And that's because the lender doesn't make any money unless you use it.
Good point.
So then you're forced to meet that criteria. And then, of course, if you don't need the money, then you got to start sending it back when you're getting your monthly payments. It can be a big hassle. Well, with a reverse mortgage line of credit, you don't have that problem. They don't care if you don't draw it right away. It'll sit there unused, no interest cost, and it's growing over time. What could be better? That is, in my opinion, the perfect rainy day fund. The point is, don't wait till you really need it. Get it now so it's already in place. You'll be happy you did.
I love it. Well, this has been the AAA section. Ask Art anything. And Art, thank you so much. I really appreciate that. If you missed the rest of the show, this is probably very valuable because it hits on 3 different types of people and 3 different situations. Art, thank you so much. I'll turn it back over to you.
All right. Thanks, Jeff. Okay. Well, thank you, everyone, for watching and listening to this week's Mortgage Minute. Hope you have a great weekend. Keep an eye out for that Final Four, which is Saturday. And of course, we continue to have all the best wishes for our folks up there in Artemis 2 as they approach heading to the moon and going around the backside of that. And of course, I'm happy that baseball is fully underway. So again, have a good weekend, and we'll see you next week on the next edition of the Mortgage Minute. I'm Art Alvarez with Mortgage Works, where we have the answers and they're on the house. So long. Take care.